Well, good morning, Bob.
Good morning, Bill.
We have a guest this morning. We have, I'm not sure what he is. He used to be our general counsel. Now he's our, well, I guess he was chief legal officer.
Guru.
I guess he's sage and guru. We have Bill Olson, who has actually had experience working in a savings and loan.
I have.
And he has had experience in a data company. And I'm not sure what you call us, but we'll just call us a technology company and leave it at that, all right? And he's going to talk about lots of things this morning related to lending.
And regulation.
And regulation. Well, there's not a whole lot of difference anymore. There used to be, but not anymore. Today, to make a loan, you have to understand the regulations.
Right.
And if you understand the regulations, maybe on a good day you can make a loan.
Well, one of the things a lot of our clients regularly ask us about is the CFPB requirement of notification of the borrowers. You know, any document that's used in the valuation of the property in support of the loan is supposed to be provided to the borrower. And they say, well, does that mean this document should go, or how about this document? What if we don't really use it in the valuation, but we use it as background or to review the valuation? Should that one go as well?
So we have two divergent schools of thought in our clients. One is you give them everything in the file. You just send it out. If we take it in, we send it out if it's got a number on it. And the other school of thought is, no, let's just give them the one we use to decision their loan. And we've got everywhere in between. So Neil is going to
Definitive answer.
solve the problem. Okay, solve the problem. And so, by the way, one of the interesting things is that, like all attorneys, I'm sure he'll give you a disclaimer. Don't rely on this. It's just intended for information. That's right. It's sort of like economists, on the other hand. Okay, so
That way we're always covered.
So let's talk about the two. Neil, tell us about the two extremes and kind of talk about that.
Okay, fair enough. Now, we'll give you one disclaimer. It is in fact true.
I knew he was going to give a disclaimer.
It is in fact true that I work for two savings and loans.
Did they both go out of business?
Both of them were taken over by the federal government. So I'm not sure how much that. So let me talk just a second about this. Is a change to Regulation B. This came in Dodd-Frank, and so it was part of that whole passel of things.
And Reg B implements the Equal Credit Opportunity Act.
That's right.
Which is a fair lending and non-discrimination sort of piece of legislation.
That's right, and it's consumer. Right. It is a consumer legislation, which is why now is with the Consumer Financial Protection Bureau. This has been in effect for applications after January 18th or something like that. But basically, let me read the core of the thing. I know that's just to make it simple, but it just says a creditor, a lender, shall provide an applicant a copy of all appraisals and other written valuations developed in connection with the application for credit to be secured by a first lien on a dwelling. Right.
Okay, so if it's not a first lien, now home equity loan could be a first lien.
That is true.
But if it's not a first lien, my favorite word is doesn't. It's D-U-D and apostrophe D.
Right.
It's in the dictionary regardless. It doesn't apply, right?
That's right.
So it only applies to first liens, and then let's read that closely. What that says.
Right.
It says a copy of all valuations.
Right.
So if we don't do evaluation.
Right.
If it's not an evaluation, it doesn't. That piece, other pieces may apply, but that piece does not apply.
Right. Right. And all means all.
All is all. And so all evaluations done, procured. What does it say exactly again? Let's go to that language specifically again.
Well, right, because this is a big change. In the old rules, it was you were obligated to send the appraisal that you used in the process. This one just says developed in connection with an application for credit. So you're right. When they're saying mean all, they mean all. They talk about appraisals and BPOs and AVMs and every other kind of thing like that.
Well, what about if you get an appraisal in and you think the appraiser maybe missed a few relevant comps, and so you suggest that the appraiser goes and looks at those comps, and the appraiser says, oh yes, I should have seen those. here's the new value.
And send in a supplemental page. It's quite common, and for our clients out there, this would be a common practice, and it's perfectly permissible under the banking regulation. This is not any violation of independence. You say, send me some more comps. You got some better comps? Send me some more comps.
Yeah.
And because these don't seem to support what you're saying here. So the appraiser sends in a new comp sheet. This is quite common. Sends in a new comp sheet, and with that new comp sheet, they may not change the value much, but maybe we need another $5,000. We found 3 better comps, or 4 better comps, and we bump it up 5,000.
Right.
It's quite common. Now let's talk about that scenario.
Okay. Well, so you have an A or a B. In the A case, which is probably where this is normally happens, is that you get the appraisal, you review it, and you say, you know, I'm not sure this is really supported. You talk to the appraiser and you say, hey, you know, you got to take a look at the appraisal. Says, you know, you're right. They look at it and they redo the appraisal and they send it back in. Well, until the lender has actually accepted the appraisal, they're not done with that appraisal. And even the CFPB realizes that there could be a lot of little edits and edits and edits. So that's A, and so you never send them the first one that they sent in. In this case, you send them the one that you finally ended up with, that we sort of we accepted, we viewed, and said. The B case is that you got the appraisal, you seem to be happy with it, and then you excuse me, and you sent that one to the customer. If you do another one, you got to send the second one too.
It's more problematic in jumbo loans. So, because you tend to get 2 appraisals, and you may also have 2 reviews.
Yes.
And so you may have 4 values, 4 different values that are moving around, and most lenders, by their conservative nature, are going to loan on the lower of the 2 or the lowest of the 4 if you have 2 different values stated in the reviews.
Right.
And so let's talk about that disclosure requirement.
Well, if I have a jumbo loan and I order 2 appraisals, I'm going to have to give you both appraisals. That's pretty easy. And of course the confusion, you know, underlying this whole thing and the anxiety of the lenders is that now I've given you 2 appraisals with 2 different values. If I help the consumer, just confuse them in some, and we're going to see how that plays out. But now I do a review. If the review says, you know, Bill, I thought your appraisal was just, you know, it was fine, you know, I may want you to fix this and that, but the value was fine. That review, that actually shows up in their compliance guide. That's not considered evaluation. But if you go in and you say, you know, I reviewed this and the value wasn't really right, and they render a new value, that's an appraisal.
It's got to go.
That's got to go too.
So let's talk now about the particular case. Let's change gears a little and talk about the particular case of an AVM. It's quite common for the GSEs to want you to run their AVM, for example, the home value estimator.
Yep.
To talk about some specifics. And many of our clients also pull third-party AVMs, and they get values all over the place. How about that?
Hey, you got
If it's evaluation, it's got to go.
That's absolutely.
Even though an AVM is not an appraisal.
That's right. Even though you could not work, they say BPOs too. Even though an AVM and appraisal by them, a BPO by itself, you could not use that for lending decisions. It's still a value.
Still got to go.
Still.
Let me ask you one other thing. A lot of lenders who are out there marketing and trying to get borrowers to sign up for a loan will use something like Zillow or one of those web-based things to get a value so that they determine whether or not the loan has a chance of even going through.
Well, now let's talk about you brought up some nuances.
Yeah.
One is the AVM may be used to solicitate the business. That's not to make a decision.
Is it part of the decision process? That's what I'm asking.
Well, typically no. It's a solicitation. I think if it's a solicitation, and we're going to ask Neil's opinion, but we've never been short of an opinion. We've never been short of an opinion. If it's a solicitation, typically we have told our clients no disclosure. All right. If it's but there is a fine line. Where does the solicitation stop and the credit decision begin?
Yeah, what if that loan officer says as part of the loan file that they took it and they got this value and it goes all up to the underwriter? Is that part of the decision?
Okay.
See, at least I know where to give it to Neil.
Well, again, sort of split it in the middle. We're going to split it one way or another. Remember what it says? It talks about an application for credit. And an application for credit, now this is going to change, by the way, with the new integrated disclosures, and it's going to be tighter. But today, the notion of an application is that you need a certain amount of information before you consider to have an application. There's kind of like 6 more or less consistent things plus anything else you need. So the question is, well, when did I do this? If you take Bob's view, or his says, well, I took this thing and I just kept it in the file and we just carried it forward. Well, you managed to take that into the application. But if you use it for a solicitation or I'm just talking to you on the phone and you're saying, I'd like to refinance my house and I think it's worth $250,000, and the loan officer uses, say, Value Site and says, I think it's probably more like 225. Just in that negotiation process, we haven't even got an application yet.
Yeah, most of those applications, most of those solicitations have what I call lawyer language in there that says, this is not used for credit,
Right.
this is not used for any part of your application, this is purely used to get you to apply for a loan.
Yeah.
If you read it, but nobody reads the fine print.
You don't read the fine
Till we
print?
get into litigation.
That's right, but that's exactly right. It's a solicitation. We're not there yet.
Well, we are there in terms of time. We're out of time. So we need to break this off. This is FNC's Morning View. Normally I would say I'm Bill Rayburn with Bob Dorsey, or I'm Bob Dorsey with Bill Rayburn. But today we're going to change that. This is Neil Olson, Bob Dorsey, Bill Rayburn signing off. Jolly Roger, over now.